Hello my fellow investors. Today was an absolutely gorgeous day when it came to stocks here in the US. You guys are looking at the S&P 500 heat map right now, and it is just a sea of just absolute red, and I absolutely love it. If any one of you guys know me and know this channel, well, you guys probably know why I am in love with seeing these kinds of numbers. For all those of you guys that may be new and you're probably wondering, this guy's absolutely insane. What? How could you be happy about companies falling 2+%? That's absolute insanity. What's wrong with you? Well, then I highly encourage you to watch this video because I'm going to explain as to why we still have a lot more to go, fortunately, and why I actually love to see companies falling 2.94%. 2.3%. It is, to me, this is an absolute gold mine. So guys, with that said, let's actually get started with this video. Now you guys just saw the S&P 500 heat map. Overall, let's actually take a look at the three indices when it came to the United States. Looking at Dow, it fell around 1.91%, 643 points. The S&P 500, which we just saw the heat map, it fell 2.14%, around 90.5 points. And the Nasdaq, the most overvalued of all of them, mainly because they're filled with tech stocks, it fell 2.55%. And to people who are probably looking at this and you bought companies that you don't really know why you bought them, and you probably bought them out of hype, you're probably bleeding a lot right now, and I really do empathize with you because I have lost a lot of money. However, now that I have actually become a value investor and I actually look at companies based off of their fundamentals, looking at them in the form of like net income, free cash flow, etc, 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 shares outstanding, the most underrated one of them, all of them, I look at this, guys, and I'm just like, it's about time. Now granted, even though, guys, today was a big fall, overall, within the past month or so, we are still significantly up. At least on the S&P 500, we are still up around 3.68%, as y'all can see right here. Coming into the Dow, we are up 3.14%, and of course, the Nasdaq on the month, we're up 3.25%. Now, we can't say the same thing about the year to date. The Nasdaq is actually down 21.8. It's essentially a bear market. Anything lower than 20%, it is a bear market. S&P 500 year to date, it is 13.73. And the Dow, we are down 9.63. Now, most of you guys are saying that is just way too much. Oh my God, can this stop? Well, I'm here to tell you guys that unfortunately, it's not going to stop. And I hope that it doesn't stop. And by the way, hopefully after watching this, guys, you can see as to why you want this thing to fall. So now I'm actually going to bring in the receipts as to why I actually believe that this thing will continue to fall. So let's actually take a look at some of these valuation metrics. We are going to start off, guys, with the yield curve. This is something that I have brought up a lot on my channel, what yields are and how they essentially work. Basically, the yield curve in layman's terms, the further out you go when it comes to maturity date, the higher yield you should get just because they are more risk avert. Unfortunately, right now, we have a massive inversion on the yield curve where some, if not most, of the lower years when it comes to the yield curve is actually higher yield than that of the later ones. I think it got to the point where the 6 months even inverted with a 30-year, which is just mind-boggling. So that's not something that you want to see. And when it comes to this first valuation, guys, the yield curve, according to this site, Current Market Valuations, it was actually updated as of August 18th, 2022. The yield curve, guys, according to them, is currently showing an overvaluation. The overview reads, the US Treasury yield curve is quickly flattening, meaning short-term interest rates are moving up closer to or higher than long-term rates. This unusual occurrence has historically been a very reliable indicator of an upcoming recession. Since World War II, which, by the way, actually full stop right there, upcoming recession, we are already in a recession, guys. We already had 2 quarters of negative GDP. So this right here has already come true. We are officially in a recession. It continues to read, since World War II, every yield curve inversion has been followed by a recession in the following 6 to 18 months, and recessions are naturally correlated with decreased stock market returns. The below chart shows our model tracking the spread between the 10-year to the 3-month US Treasury yield. The last inverted curve of 2019/2020 did in fact precede the subsequent April 2020 recession. While our 3-month and 10-year model still shows reasonably normal performance, short-term yields are quickly moving up in and portions of the yield curve are now beginning to flatten and even invert. So they actually point out the whole 19-20-20 thing. However, I can't really say that this is actually the case because again, it was COVID that happened, and you know, when you stop the entire world economy just at the halt in just like the span of just like a couple days, you're going to get massive shockwaves, which by the way we are still feeling even 2 years later. But just because I don't think this last part gives credence to the fact that it is overvalued, the final part of it saying short-term yields are quickly moving up and portions of the yield curve are now beginning to flatten, this is 100% true, guys. And in fact, here are the bond yields when it comes to all of the US Treasury yields. We can see that there's a lot of them, guys, that have inverted with like the 10 and 30 year. For starters, the 6 months and the 12 months have actually inverted with that of the 10 year in both scenarios. We got the 2 year also has inverted with the 5, 10, and 30 years as well. So overall, this is actually pretty bad, right? I mean, I didn't even mention the fact that the 5 and the 10 already inverted too. So overall, guys, the yield curve is showing massive inversion, and according to this, well, the fact that it is inverting and it is flattening, well, it's already flattened, it's now in the inverted section, we're probably going to see a massive pullback when it comes to the stock market, making this first indicator overvalued. The second one that we're going to look at, guys, is none other than Warren Buffett's favorite indicator. In fact, it's even titled after him. It is called the Buffett indicator. It is actually very simple to calculate. It is just the US market cap divided by the current annualized GDP for the United States. And as you can see right here, this is currently at 182%. And I did the research, and this actually turns out to be, guys, the average is around like 80 to 86% or 85%. We are at 182. So yikes, that is bad. Now, as of today, this might actually be a little bit lower because this was taken as of Friday, August 19th. But nonetheless, guys, it is still massively overvalued as a whole. And then the last one for me to show you guys, it is the price to earnings ratio. And what this basically does is it takes a 10-year PE ratio when it comes to the S&P 500 and then puts it at an average. And reading the overview, it states the PE ratio is a classic measure of any security's value, indicating how many years of profits at the current rate it takes to recoup and invest in the stock. The current S&P 500 10-year PE ratio is 31.2 points. This is a 55% above modern era market average of 19.6, essentially 20, putting the current PE at 1.4 standard deviation above the modern era average. So right then and there, guys, the fact that it's 55% above normal is telling me that this needs to fall about more than half. Looking at the Buffett indicator, if the average is around like 80% to 90%, this again needs to fall down in half. And when it comes to all the yield curve, guys, this is again showing that this may actually fall by a significant amount. Obviously, this one doesn't show the specific number, but if 2 of the 3 is saying by half, then probably this thing needs to fall down by half. So as it stands, looking at back these indexes again, we can see that, yeah, with the NASDAQ being at 12,000 points, S&P being at 4,000 points, and the Dow being at 33,000 points, and all these indicators saying that, hey, this thing needs to fall down in half, yikes, that is absolutely maddening. But now I'm actually going to tell you as to why this is a beautiful thing. And we're going to do a little bit of math behind this. So let's actually get started with that. Let's come back over here to the S&P 500 heat map. And we're going to use, guys, the company Apple, because it is essentially the gold standard when it comes to pretty much every single company. Apple, guys, the current share price is $167.57. So let's actually take a look at Apple in Seeking Alpha just to see what kind of information we can get right off of here. First of all, the 52-week range, guys, it is between $129 and $183. So the fact that it is at 167 and this thing is saying that this might need to fall in half, this means that if Apple were to actually fall down in half, we would actually be getting, guys, a price tag for Apple of $83.78. Now, the question that I want to ask all of you guys is, if the company does fall down to $83.78, has anything actually changed with the company? In reality, are people going to stop buying iPhones? Probably not, right? Apple, it is just one of the biggest Goliaths when it comes to just market share. That is insanity. So the way that I look at this, guys, is, okay, if I want to invest in Apple, and the current share price is $167, but I can only invest $100, right? Well, if we actually do the math, so let's actually say that you can only put in $100, and then at the current share price of $167, you actually get, guys, around 0.596 shares. So let's actually go a little bit further when it comes to this. Let's see that dividend yield. As you can see, per share we get 23 cents. Obviously Apple doesn't have a big dividend yield, but we're using this as an example. So let's actually take this dividend yield and then now multiply this 0.596 times that 0.23, and we can see that for the shares that we just bought, we are getting around 14 cents. So not a lot, right? 14 cents per quarter, it is not a lot. But now let's actually do this exact same math, but now with the share price cut in half. So let us actually now put in the $100, divide that by the $83.79, and as you can see, guys, now this gets us a lot more than one share. This actually gets us, guys, 1.2 shares. I'm gonna round up to 1.2 shares, and doing the same math, taking this 23-cent dividend, and we multiply this by 0.23, so you can see now the amount of dividends we get is 27 cents instead of 14 cents. So almost half as much. Now, you're probably saying there really isn't much difference when it comes to 14 cents and 27 cents. The point is that your money goes significantly further when the stock price falls than if you were to buy it at these really, really high valuations. And I have been getting a lot of comments recently telling me that, oh, you don't buy anything because you think everything is overvalued. Guys, I do think everything is overvalued. I absolutely do. There are companies out there that are just massively, massively overvalued. We have been doing, guys, stock evaluations and making target share prices for most of these companies, and we have seen that most of them are really overvalued. So the fact that all these indicators is telling me that they should fall by around half, and the fact that the market is currently wavering, honestly, like as the day passes, sure, we have green days and we have massive green days like we just saw like last week. I think overall, guys, in the long term, we're going to see a massive drop still, because again, the valuations are just way too much. Could I be wrong? Sure, I could be wrong. But at the end of the day, guys, companies do fall down to their fundamentals. No amount of hype can actually fix that. In fact, let's actually take a look at some of these hype companies. I'm actually going to show you guys Peloton that has earnings coming out this week. Look at this, guys. On the 1 year, it is down 89.14%. On the year to date, it is down 67.1%. And actually, looking at the advanced charts, take a look at this. Look at absolutely this just massive just rise and then just collapse, right? Every single one of these hype companies that people bought in at around like 2021 have this exact same pattern of just going up and then just coming right back down. Every single one of them, name it, Palantir, Peloton, Affirm, all of these companies have the exact same graph pattern, and all of these losses could have been avoided just by looking very quickly at like their net income and revenue. Just with those alone, you could have essentially avoided all of these losses. So yeah, I think that most of these companies, guys, are overpriced. And I know I have a couple people watching me right now. Elizabeth, I'm gonna shout you out, where she's pretty much just saying like, there aren't any pharmaceutical companies. She wants to buy pharmaceutical companies, and she's just like, there aren't any pharmaceutical companies that are a good value. There aren't any companies that are a good value. I would kill to buy into AVGO. This is my baby right here. And a price tag of $528? No way. I'm not doing that. That's insane. Apple. I put Apple, I think, around like 120. It is now 167. Microsoft, current price of 277. I think I put it at like what, 170 or something, or maybe like 225, I forget. But nonetheless, it still has to fall a significant amount. So the fact that you're not finding any good stocks to buy into now, you're not alone. There really aren't any. Now, you could wing it and just be like, yeah, I'm just gonna buy it regardless because I don't really care about valuations, and that's fine. But understand that when the market continues to fall, you are going to be in the red. So for all of those people who are probably looking at this and you're like, nope, too much stuff. I don't want to know anything about net income, free cash flows, whatever, Buffett indicator, PE. I don't care about that. I do have another solution. And this is by far the best solution that, actually that pretty much exists, and that is essentially, guys, buying into low cost ETFs every single month, no matter what the stock market is doing, whether it's up, whether it's down, whether it's sideways, it doesn't matter. You pick a day out of the month and then you put in 500, 1,000, whatever you may want to do. Take it as like an expense. That's like you would pay off like a mortgage or like a rent or whatever. Put it as an expense, take it out, and just put it into a low expense ratio ETF. One of my favorites is VOO. I actually made a video about what ETFs are and like how you should do it. But nonetheless, I think this is the best thing you can do, because if you overall overpay and then underpay, you will eventually pay the average. So doing this month in, month out, you will eventually pay what the market average normally is. And since ETFs, you don't really have to worry about any fundamentals because they're self-correcting, this is a much better strategy if you don't want to take a look at any of these, free cash flow and any of that stuff. So that is essentially, guys, what I highly suggest doing when it comes to this market environment. When I see red, I gotta be honest, I am salivating because this is juicy. Now, I'm not salivating as much because we're still way overvalued. It needs to fall a lot more, but I can guarantee you, right now, a lot of people are saying, you don't buy anything, everything is overvalued for you. I can guarantee you that if this thing falls and stocks are at their all-time low and then some, I'm gonna be like, I'm gonna buy that, I'm gonna buy that, I'm gonna buy that. Oh, don't have any more money, sell a kidney, keep going, keep buying, keep buying, keep buying. People are then going to call me crazy because I am buying stocks when everybody believes that stocks are worthless. We saw this in 2008, we saw this in 2000, and we will probably see this again in the next upcoming years. So with that said, guys, that pretty much does it for this video. Like if you like, comment, subscribe, really does help it with the algorithm on YouTube. You guys can follow me on my new tech sites, link in the description below. So with that said, peace out, and I will see you all in the next video. Remember, guys, red is actually good when it comes to value investing.